What's going on, guys? Brian here. Today is Tuesday, March 22nd, 2022, and the market is closed. Jumping right into it, we're going to be focusing on just Tesla for today's video and mostly talking about the options chain as well as how you can spot a potential upcoming gamma squeeze. Some of you guys might know this as a short squeeze, but usually it's the options market that's driving a squeeze like this to happen. It's also known as a convexity squeeze, but I'm going to try and keep this video a little bit more simple than some of the other ones. Now, as we look at Tesla on the daily time frame, I have a few key levels marked off. We have the 800, we have the 950 level, and we have the 1000 level. Tesla has rallied over 30% in 1 week right here, over 240 points, 235 points or so, give or take a few, right? As we look at this, this is a move that's statistically not normal. We can see Tesla has been a stock that has done this on numerous occasions before, and it ends up catching option sellers in trouble. Now, why would option sellers choose to sell calls down here last week? Let's kind of rewind for a second and think about the narrative of what's been going on in the market. If we actually pull up a study and let's put on the implied volatility study for Tesla and take a look at something, because this is also important. If you can understand your opponent, or if you can understand the person on the other side of the trade, you can understand when they're in trouble and you can use that to your advantage whenever you're trading. If we take a look, this was last week right here. Tesla's implied volatility was over 75%. And then we can see this week it drops down to 60%, and now it's hovering around 66%. So anyone that was selling options in this vicinity here last week was essentially collecting a decent premium for doing so. And if you're an option seller, it's in your interest to sell options that are pretty elevated because you're hoping to collect on that premium. On top of that, if we were to take a look at the VIX and zoom in for a second here, we can see that the VIX had a serious sharp sell-off also. So the VIX is down over 30%. And if you didn't know, whenever the VIX is down, that drops the value of options across the board. Now, selling options whenever the VIX is pretty high is a strategy that a lot of advanced or experienced option sellers do. So anytime the VIX is over this level or over 30, it pretty much means people are buying options for an inflated price. So if we jump back to Tesla and we think of those two concepts, let's take a look at the chart right here. Anybody looking at Tesla last week and it being below 800 or around 800 or even around 820 would be telling themselves, what's a safe call to sell? Because option sellers are pretty much always selling calls and puts. Whenever you sell a put, it's because you think the stock price is going to stay above that put by expiration. And whenever you sell a call, it means you think the stock is going to stay below that strike price by expiration. Now, whenever you sell a call and a stock price is rallying, you're going to be in serious trouble because you, in theory, have an infinite risk potential. There's no ceiling on how much you can actually lose whenever you sell a naked call option. Now, why would people sell the 1000 strike? As we just established before, Tesla has rallied over 200 points. That's not something it does within a 1 week time frame, or even within a 2 week time frame. It's very rare to see. As we zoom out, we can see it has gone on impressive runs before, and each of these have been gamma squeezes. So this was a gamma squeeze right here. I actually did a YouTube video on the gamma squeeze that occurred right here as I swung calls from this time frame into this time frame right here. It was a 1 day hold. It was an overnight hold, actually. It was a great trade. And this was another gamma squeeze that occurred right here. And then we had one that occurred right here also. So what we're experiencing is another one. Now, the thing is, if we pull up the options chain, how do we know that this is likely to be a gamma squeeze? There's something, let's also backtrack for a second and take a look. This is the strike price in which we're talking about, which is the 1000 call that's expiring on this Friday. And we can see the open interest is 20,000. As we scroll up the options chain, we can see that there's nothing with that high level of open interest, as well as if we were to scroll down, we can see there's nothing of that level of open interest. Now, whenever there's a one strike price on the options chain that has that high open interest, and you don't really see anything else matching it, that's one way to interpret it, as if there's naked option sellers there. Because generally, whenever you see a spread, there's usually going to be another strike price above that strike price that has a matching open interest. So say, for example, if we were to take a look at Tesla for next week, and let's scroll down here and see if we see anything that matches. So right here, Okay, so we see this 2,000 open interest, 2,000 open interest. This can be interpreted as someone running a bear call spread, which means they're selling the 1050 call, and then they're also buying the 1,100 call as a hedge. So in other words, as Tesla starts rallying and rallying, as long as it remains below 1050, they'll profit. They're buying this call as a hedge essentially for that call, and they're doing it by way of a spread. It's one of the core vertical spreads in the options market, or one of the core option strategies out there. Now, as we scroll, let's just see if we see anything else of significance that might be matching. We can see 1,000, 1,000. You see these numbers also kind of match. So if someone was to essentially run an iron condor, they might sell this put, buy this put, and then they'll sell this call and buy this call. And they're pretty much saying, as long as Tesla remains within these two strike prices right here, this is going to be their max profitability zone. Now, if we go back to this week's expiration, as we just looked at, there's nothing else that's matching this level. Now, why would someone sell a naked call option on Tesla? There's a ton of reasons, and again, there's no way to know for sure this is just one way to think about it, because usually, again, this is unusual to see just one strike price with that much open interest on a single expiration. And it's not even like if we jumped into the next week, we don't see the 20,000 popping up there. Also, there are different services out there. So say, for example, there's different options flow services out there like Quant Data and Flow Algo, and I think Cheddar Flow, and even Option Strat has a very simple live flow scanner and things like that. But this is an example of a spread here. And usually whenever a spread will go through, it ends up being submitted and it goes through as one order. So this case right here, this is a short put condor, and you can see that the quantity is 80. So that means for each of these strike prices, this 700 put, this 650 put, this 850 put, this 500 put was all submitted by one person, one order, and it's 80, 80, 80, 80, 80. That's how you know it's a spread. If we jump back to this here, again, there's not really any evidence of that being shown on the options chain here. And as we circle back, there's something else to also talk about: the deltas on these options. So this option right now has a 0.46 delta. However, last week when Tesla was trading around 800, that call had nowhere near that high of a delta. It more than likely had a delta closer to 10 or 8.08. As we take a look at this, let's just say Tesla was trading at 1,000 right now. We can see that after hours it's not at 1,000, but let's just say it was at 1,000, and we looked 200 points higher, which would put it around here, and we take a look at the delta on that option. It's 0.02. Now, some people use the deltas as a proxy for the probability of success that this contract will expire in the money. So what that means is, by this having a 0.02, it means Tesla has a 98% chance of closing below 1,200 by this expiration, which is in 3 days or this Friday. 98%. So if you're an option seller, you're telling yourself, hey, I can just sell this option and collect 66 cents in premium, which is $66 in credit. That's a very easy, high probability strategy. However, you're taking on tremendous risks, because there's nothing to say Tesla won't close at 1,250. That's going to make everyone selling this option, which statistically has a very high odds of playing out, very nervous as Tesla is continuing to rally. Now, last week, this call obviously did not have a 0.46 delta, as we just established, because it was nowhere near close to being at the money. So let's take a look at the following week calls, and then let's also move 200 points up, and let's take a look. So we'll see right here, this call has a delta of 0.07. So if you're an option seller, you're pretty much telling yourself this has a 90% chance, or more than 93% chance of expiring out the money. So you can come here and you can say, I'm going to sell this call for $3.20. Now, the thing is, at the beginning of this video, we took a look at the IV on Tesla, and Tesla's IV was 10% higher last week. On top of that, the VIX was also higher. So we knew the implied volatility for the entire options market was higher than it normally is. So this call was, in other words, selling this call last week would have been a great thing to do if you're taking a high probability success trade. Now, the problem with the Greeks on the options market is they can't account for technical analysis. They can't account for breaking news. They can't account for unforeseen or unexpected events. It's implying certain moves based on the the Greeks, and based on a very complex mathematical formula that's being calculated, thankfully, by the softwares in which we use to trade. So with that being said, if you decided to sell this 1200 call, you're actually taking a high probability trade. However, everyone that sold the 1000 call last week who thought they were taking a high probability trade, they took a look at the options chain. We don't know when these contracts were actually written and sold to everyone, but this is very dangerous in this case because there's no sign of evidence with it being a spread. On top of that, we can see the insane amount of volume that's happening here. So if we jump over and compare Tesla on the left hand side and Tesla on the right, here's the 15-minute time frame. And actually, let me just jump here and let's just switch this over to this so we can see the levels. So as Tesla is last week Monday down here, and we take a look at this call was going for 60 cents. Again, a very, very high probability trade. You're selling a call 200 points higher that expires within 2 weeks on Tesla, and you're thinking you're pretty safe. There's no real reason to hedge this. However, as Tesla starts squeezing and rallying with the market, traders start running into trouble. So as of Friday morning, we can see a ton of volume starts coming in here. And then on top of that, this is momentum traders coming in, establishing that there's going to be some sort of risk for option sellers for their strike price because there isn't much evidence showing they have too much protection. Now, what happens if you're an option seller? I've sold naked call options before, and I can tell you it's one of the most terrifying things if you're not prepared to buy the shares to actually offset your risk. Whenever you sell a call, so let's just say I was to sell this same call right here, this 1000 call for $21 right now. I'm essentially safe as long as Tesla stays below $1,021 because that's how much premium I'm collecting. So I'm giving myself 21 points of runway. However, if you sold this call last week for 60 cents, so let's just say $1, you are pretty much in serious trouble. If Tesla was to close any amount over $1, you're going to be down tremendously. On top of that, your current position right now, if you haven't hedged or you haven't done anything to protect yourself, right now this position is currently down for an option seller 3,600%, which is an insane, scary thing to see. It pretty much means you're down $2,100 for selling a 60 cents option, which is going to make you feel sick. You'll ask yourself, why didn't I just buy that option instead of selling it? So what does an option seller do to protect themselves? They have the option to start buying stock. If you sold this option and you decided to buy 100 shares of Tesla to offset yourself, or not even 100 shares, you would buy the amount of shares to match your delta. In other words, if you were to sell this call here tomorrow and it has, assuming it remains with the same delta 0.46, what you can do is you can buy 46 shares of Tesla, because for every 1 point that Tesla goes up, you're going to make $46. At the same time, you're going to lose $46 from selling this call, because that's what the delta is. Every 1 point Tesla goes up, this option is going to increase by however much the delta is. Now, the problem is that the delta does not remain stagnant. As Tesla goes up 1 point, this delta is going to increase by how much the gamma is. So I don't have gamma in this chart, but let's just actually put it up for you guys to actually see. So this right here is the gamma, and this is what would be referred to as whenever you've heard a gamma squeeze, because as Tesla is going up, for every point it's going up, the gamma is going to the delta is going to increase by ever how much the gamma is. Now, closer and closer to expiration, the option Greeks become more and more sensitive to price movement. So that means, let's just say Tesla was to jump up tomorrow and it gapped up 5 points over 1,000. This 1,000 call option is going to bump up to here. That means the delta is going to increase from 0.46 to 0.53, hypothetically speaking, and then it's going to continue to increase the higher and higher Tesla goes. The higher and higher Tesla goes, the more and more shares whoever sold this option is going to have to buy. Now, if we jump back to this for a second here, and we take a look at this open interest, there's 1,460,000 open interest. That means that's how many written contracts there are. If you don't know how to interpret this, let's just say I was to write a contract and sell it to the markets. The open interest is going to equal 1. Let's just say you decide to buy that contract from me. The volume is going to equal 1. However, if you sell that contract to your friend, the volume is going to increase by 1. And then let's just say your friend sells that contract to another friend, it's going to increase by 1. And then let's just say you buy that contract back from that other friend, the volume is going to increase by 1. And now the volume is going to be 4. Even though the open interest is just 1, that's still the same contracts that was open, written, and then sold essentially to a person, even though the volume reads 4. So what we're seeing right here is the volume is 1,000. Sorry, I said the open interest was 146,000. I meant to say the volume, which is right up here in this column, is 146,000. It's the open interest that's 20,000. So that example that I just used is just showing you guys why the volume can be much higher than the open interest. This is a lot of now day traders and momentum traders coming in and scalping this option. They're buying and selling it, and they're scalping it all day long. There's new buyers coming in holding this. So there's a lot of attention coming around this option right now because of the awareness that it has the highest open interest with no real signs of protection to the upside. So option buyers know if they start bidding this up, the option sellers have to start buying stock to protect themselves to offset their risks. Now, tomorrow morning when the options market, or overnight, I believe it's around 3 or 4 a.m., you can actually see this update on Thinkorswim. But tomorrow, by the time everyone's up before the market opens, you'll notice that the open interest is more than likely going to change. We're probably going to see an increase in the open interest all the way up here, or they're probably going to sell some strike prices in between. So you see these are all divisible by 5 here. We'll probably start seeing the 1026, 1027, 1028, 1029. So the strike prices in between, we'll probably start seeing the open interest increasing for some of these because the option sellers that sold their strike price, they're now going to start selling more calls to essentially offset their loss from selling this option last week as they've been buying stock to offset their delta. So whenever a call option is sold and the stock price is rallying to it, it's forcing the people that sold the options to start buying stock because they don't really have much of a choice. The risk is way too high. By buying stock, they're offsetting their loss because let's just say by the time Tesla reaches 1,000, let's just say they end up owning a total of 100 shares. That means every point Tesla goes higher, they're going to gain $100 for every point Tesla goes higher. However, they can no longer lose more than $100 for every point Tesla goes up by selling the option because at one point, and I'm glowing over this pretty quickly. Again, I don't want this to be one of the longer videos. I would highly encourage you guys look this up on your own and try to look to more in-depth videos. I've actually did a video on the Tesla squeeze, as I mentioned earlier, that I took, the gamma squeeze that I took, I think it was in October of last year. And you can check that video out, whereas I try to explain gamma squeezes a little bit more. But as we jump to this right here, we can see that the deltas, eventually the delta as we scroll up is going to become 1. Now this is after it becomes deep in the money, but this is the equivalent of owning, at this point, this is the equivalent of owning 100 shares of Tesla. That's what this is saying. So if you were to buy, say for example, this call tomorrow and Tesla kept rallying, every 1 point Tesla goes up, this option is going to, these options right here are going to increase by $1. So you'll be making $100 every point Tesla rallies. Or you could just buy 100 shares because 100 shares means the exact same thing. So hopefully this is providing a little bit of an explanation. To recap or to conclude, what you want to do is take a look at the options chain and see, where do you see, whenever you have an idea or you thinking something is going to squeeze towards a level, you want to take a look at the open interest, see if there's any signs of there being any type of potential hedging. Use whatever traditional technical analysis you use. Maybe you're saying this was the break of this, it was a breakout right here. Tesla crossed over the 200-day moving average. It closed below it. There was increase in volume here the day before. You can see the increase in volume here. It broke over the 50. Whatever your reasons are for getting in the trade, just know that technical traders and momentum-based traders are in control of a move like this and looking to essentially exploit the option sellers. As another key thing that you want to look for, it also works if you're looking at the options chain. You generally will want to see more open interest above higher than the strike price in which you think something's going to go. So in this case, let's just say last week you were to buy the 950 call, which would have been a sensible option to buy, and you see this open interest. You want to see higher open interest above the strike price in which you're looking to take, because assuming someone opened this as a spread right here, anywhere in between here they're profitable. So there's a little bit of a leeway or some room, but to anyone running this type of spread, they're acknowledging that it's probably going to go a little bit higher, and this is not necessarily the line in the sand. It has room to go higher. And then at the same end, the same thing on the short side, we can see right here. You're not necessarily, let's just say you were to buy this put right here, the 950 put. You want to be buying a put that doesn't have the last highest open interest on the options chain. Generally speaking, you want to see something that has more open interest above it, because it definitely means it's probably going to go past your strike price, and you probably have a higher odds of it working out. And if we jump back to this chain here, so buying this call option last week wouldn't have been probably the best thing to go with, because it was such a low probability trade. The more sensible one to take would have been something like the 950 call last week, just because this contract has 2 times as much open interest. So this call had a higher chance of actually going in the money, versus this one doesn't really have a high chance of expiring in the money. But once the squeeze is happening, if more and more buyers keep coming and putting more pressure onto this contract, option sellers have no choice but to protect themselves. And that's likely what we're seeing happening today. And you can see, or not even just today, for the past couple of days, I'm already in a spread here. I got to the party pretty late because I actually fumbled the ball on Tesla. I was in a net short position yesterday here because I thought it was going to consolidate around 900 for a bit. So I ran a put count on the spread, just expecting it to consolidate or at least not get any higher than 940. Had to close out my spread once Tesla got around here earlier, and then I waited until the end of the day to actually go long. So I do wish, once I closed out my short trade, only took a $200 loss, which was not that bad, and it was only about I think about a 16% loss on the spread in which I was running. So then I ended up jumping in and I ran some sort of unbalanced butterfly going into tomorrow. So as long as Tesla remains above, I think it's 995, I'll be profitable any price over that level by Friday. So if you're curious as to how I run these trades, because I know I'm getting into the party too late, it's way too dangerous to just buy naked calls. So I'm putting on a spread that has still a decent amount of delta. My thaders are not at much risk, and then it's just seeing if the gamma squeeze happens again. Now, my expectations for us to go much higher, very, very low. I don't think it's a high probability trade that Tesla will be over 1,000. However, if it breaks over 1,000, that means it's going where it should not be, and that's going to be in an insane place that it could potentially squeeze all the way up to anywhere from 1050 and even as crazy as 1,100, because Tesla has done that before and is one of the tickers on the stock market in terms of market caps that is infamous for destroying option sellers or bears. If you enjoyed the video, leave a comment down below, like the video, share it, and subscribe to the channel, guys. I'll catch you guys in the next one.